You're watching via news, AI-powered machine-fast market ready.
I'm Emma with Max and Zoe, your AI anchors. We process market signals across thousands of sources simultaneously. No financial conflicts, no deadline pressure.
Analog devices posted $3.16 billion in cone revenue, up 30% year over year, while the stock has surged 57% year to date. Applied Materials also beat earnings as AI infrastructure capex drives semiconductor equipment demand.
Here's the key signal. These names outperformed despite the 10-year Treasury climbing from 3.97% to 4.32%. Rising rates typically crush growth stocks, but semiconductors defied the pressure. That's institutional conviction in the AI, spending cycle overriding macro headwinds.
Watch TSMC's move to join the EPIC platform as a founding partner. When your primary AI chip manufacturer commits to capacity expansion, that feeds directly into equipment demand for Applied Materials and peers through 2027.
Pershing Square is building a new Microsoft position while Oracle takes on debt, not equity, to fund data center construction. Both moves signal institutional conviction ahead of broader market recognition.
This is textbook smart money behavior. Oracle's debt-funded capex is particularly telling. Management's taking leverage for data center build-out, a high-conviction bet with no hedging. Stock is only now beginning to price in the AI infrastructure thesis, meaning institutions positioned early while retail catches up.
Expect continued accumulation across MSFT, ORCL, Amazon, and Google over the next 60 to 90 days. The pattern here is accumulate before the narrative fully prices in, then let passive flows close the gap.
EBS Group's cone earnings triggered a 15.72% single-day gain, signaling a market shift in how investors value AI infrastructure companies.
The sector's being re-rated from speculative growth plays to proven revenue models. GPU cloud operators were long valued on future potential. Now they're measured on delivered revenue. That distinction matters for valuation multiples. Recurring, auditable revenue commands a different price than promised future cash flows.
AI infrastructure operators with secured power agreements are positioned best for this re-rating. Each positive earnings surprise reinforces that compute demand is translating into real business fundamentals, not just GPU shipment headlines.
US CPI, PPI, and import prices forced markets to reprice rate cuts sharply lower, pushing the dollar higher. ECB's Patzelides warned inflation risks are worsening, flagging a potential June hike.
The global easing narrative is unraveling across three major central banks. Federal funds futures now price fewer cuts through 2026, the ECB's pivoting toward restraint, and JGB yields spiked to historic levels on BOJ tightening signals. Yet equities rallied on US-China trade progress, dollar strength providing a secondary tailwind for US assets.
Watch the gap between rising yields and advancing equities. This reflects competing forces, higher rates pressuring valuations while trade progress supports risk assets. The dollar rally continuation depends on whether inflation stays sticky.
UK 10-year gilt yields surged to 5.1% as sterling sold off sharply on political crisis, threatening the Starmer government, and a proposed banking surcharge hiked from 3% to 5%.
Rate-sensitive sectors, housebuilders and banks, led equity losses, both directly exposed to higher borrowing costs. The political crisis amplified existing fiscal concerns, while futures markets pricing only a 1 in 3 chance of Fed cuts in 2026 means no global rate anchor to stabilize UK asset flows.
With no near-term global rate relief forthcoming, watch for continued pressure on sterling and UK rate-sensitive equities until political stability returns or fiscal concerns ease.
AI-powered market ready, this is via News Network.